Warm welcome to CA Raja classes and thank you so much for joining this mini and micro webinar. Before we get into the discussion, let me just take a couple of minutes to introduce myself. I am CA N Raja, a chartered accountant by qualification, a teacher and trainer by passion, and teacher for 3 lakh plus students worldwide. I started my career as a banker with State Bank of India. Then after a period of 4 years, I got into CA practice. I had my practice for 7.5 years. But I realized my calling is teaching. I started focusing on teaching and training, and today, with the blessings of God, we have 3 lakh plus students worldwide. So now it's time for us to get into the session. In this session, let us understand what is bank guarantee, its meaning, purpose, and nature. First, let's get into the meaning of guarantee. Guarantee is basically a contract to perform the promise and to discharge the liability of a third person in case of a default, and this is what we have in section 126 of Indian Contract Act 1872. So guarantee is basically a contract where you are going to perform the promise because you have made a promise that if third party is not going to perform, then you would perform. Okay, so it's basically a contract to perform and discharge the liability of a third person in case of a default. So who are the parties involved in bank guarantee? Basically, there are 3 parties. 1 is applicant, 2 is beneficiary, and 3 is guarantor. Applicant will be bank's customer. Beneficiary is the person in whose favor bank guarantee has been created, or say the guarantee is given, and guarantor is generally banker. Now let us also understand the nature of this contract, that is guarantee. Whether this contract for guarantee is a primary contract, answer is no. The nature of guarantees are collateral. It means they are consequential to the main contract between the applicant and beneficiary. It means there will be a contract between applicant and beneficiary, say for some exchange of goods or for rendering of services or for some fulfillment of promises. And if that contract is not executed, then this guarantee contract comes into picture. That's why we say guarantee is collateral in nature. Now let's say bank is going to give guarantee in favor of a beneficiary on request by applicant. What is the risk bank has with regard to guarantee? See, risk arises in the event of default by applicant. That is, applicant is supposed to perform some promise or make some action and he is not doing that. Then if the default is brought to the notice by beneficiary, then the guarantor should perform the promise. But if the guarantee is given by the bank, then bank will not perform the promise. Rather, bank will compensate the loss that was suffered by beneficiary on account of non-performance or non-fulfillment of promise, and this compensation by the banker will be restricted to originally guaranteed amount. So understand, very important. Okay, in the event of default by applicant, the default has to be brought to the notice by beneficiary to the guarantor, and guarantor is only going to compensate the loss. Okay, it's not that guarantor is going to perform the promise here when bank is a guarantor. Understand that. Okay, also understand, when beneficiary makes claim to the guarantor, that scenario we call as invocation of guarantee. If you are a contractor, you will be getting most of the business by participating in tender. If you are bidding against the particular tender, then you may have to submit a deposit. We call it as earnest money deposit. Instead of that deposit, you can also submit a bank guarantee, and that bank guarantee is called as bid bond guarantee, and they will be generally up to 5% of value of contract for which tenders have been invited. And if you look at the expiry date, it will be fixed and it will generally match with the date on which bidding process is expected to be completed and the date on which contract will be signed with successful bidder. Okay, right. So once this bidding process is completed, the bonds will be returned to unsuccessful bidder, and successful bidder will be called to sign the contract. In case if successful bidder is not signing the contract, then the organization which has called for the tender will invoke this bid bond. Okay, so we can say bid bond is more of performance guarantee, and here the assessment is focused on capability of the contractor to take up the contract which he is bidding. Okay, and in general, bidder will win a contract only after bidding many tenders. So it is possible that the number of bid bonds and amount involved in those bids will be beyond the capacity of the contractor if he is going to win all. Okay, so it's okay sometimes despite winning, if he is not taking the contract, it's normal and it's not a worrisome situation. If a contractor has completed his job successfully, let's say to the satisfaction of the employer, then automatically all guarantees should come to an end. But certain employers would try to act safe because they do not want any fault or mistakes to crop up after work completion, and they do not want to suffer any loss. So what they'll do is they will insist on a guarantee for maintenance period. That would be basically the period after completion of the project, and generally it would go up to 1 year. This guarantee would give them protection against faults which are discovered after project completion. When these faults are identified, the employer will call the contractor to rectify, and if the contractor is not going to rectify it, they can invoke the bond, get the money from the bank and get it done by someone else. Okay, so this maintenance bond is generally given for 1 year period, and maximum it will be like 5% of value of the contract. In banking, you will come across customers who are undertaking construction contracts. While these contractors receive payment from their employers, certain percentage of the payment will be retained, and generally it will be like up to 10% of each and every payment. That retained portion is called as retention money. But the problem with retention money is that this is going to affect the cash flows or liquidity of the contractor. So what's the solution? Whether employer will compromise retention money? Answer is no. Employer will not compromise retention money, because once the contract is completed and if defect is identified, then that defect will be either adjusted against the retention money, or contractor have to rectify the defect to get back the retention money. Okay, so that's the very objective of retaining portion of payment. So they are not going to agree. So what's the alternative option? In most of the cases, employer will accept guarantee instead of retention money, and this will be equal to retention money in general. This guarantee will ease the liquidity in business, and when this retention money guarantee will expire, it will expire when the project is completed, that too to the satisfaction of the employer. But of course, later on this retention money guarantee will be substituted with maintenance bond or maintenance guarantee for some more period. That is, after completion of project, generally it goes up to 1 year for maintenance period. In banking, you will come across customers who are taking up big projects, turnkey projects, construction projects, mega export projects, that too all involving high cash volume. These customers will be requiring advance payment from their buyers to execute the contract. That's basically for purchasing materials, paying laborers and so on. And for this, they also would have entered into an agreement with the buyer. But buyer will be making this payment only after the seller provides him some kind of a guarantee. Okay, that's where this advance payment guarantee comes into picture. If seller is not going to deliver the product or render the service after collecting advance, then the buyer can invoke that advance payment guarantee and get back that advance money whatever he paid from the bank. Okay, so whenever advance payment guarantee is issued, it is very important that it is tracked very correctly, because if invocation arises, its consequence will be worse than default in fund-based facilities. Okay, so how it can be tracked? Probably you can insist on a cash budget. By having a look at the cash budget, you get an idea how this advance payment is going to be utilized, and what will be the impact if the need for repayment of advance payment arises because of invocation. Thank you for watching this webinar. I am sure you have derived value from this webinar. And if you wish to learn more, I have some good opportunity for you. What is that? Check out.
It is this Credit and Financial Analysis Mastery course exclusively designed for bankers and for those who want to have bankers' point of view. This is a course which we have developed after a detailed analysis, a thorough discussion with several hundreds of bankers and finance professionals. We have identified what is their exact requirement when it comes to SME and corporate credit and financial analysis. In this mastery bundle, I'm going to give you access to various courses. To start with, we have course number 1, Basics of Credit Analysis. In this course, we have explained the basics of credit analysis through various sections, section 1 to 9. Next comes course number 2, that is how to read balance sheet. In this course, we have explained what is balance sheet, how to read them, how to approach them by using real life financial statements. Then comes course number 3, how to do financial ratio analysis like a banker. In this course, we have explained all critical ratios that are analyzed by the bankers, and we have also explained through case studies. Then we have course number 4, how to do cash flow analysis. So through this course you will understand what is cash flow analysis, how to do a typical cash flow analysis. We have used case studies, and reference to Ind AS is also included in this course. Then we have course number 5, that is how to do fund flow analysis. This is a critical financial analysis tool, and in this course you will learn what is fund flow statement, how to analyze them from banker's angle, how to prepare fund flow statement from academic angle as well. So overall 5 courses, each 1499. So aggregate price should be 7495, but you are not going to pay that. For you it's just rupees 2499 for 1 year access, or rupees 4999 for lifetime access. And it is not yet over, you have some more bonus. Bonus is course number 6, how to carry out credit risk rating for non-trading entities. These are all the topics covered in this course. Then course number 7, it is how to carry out credit risk rating for trading entities. Not yet over. You also have access to course number 8, that is how to prepare CMA report for bank loans. It's a comprehensive course which will run for 8 plus 5 hours, and you will learn entire CMA report preparation process. And course number 9, how to prepare cash budget for bank loans. Course number 10, how to assess fund-based working capital. So in this course you will understand what is working capital, what are working capital credit facilities, and how to assess them, what are the key ratios that are related to working capital, and what are the additional key analysis that will be done by bankers on working capital matters. You will get a comprehensive understanding of cash credit, export finance, and there are certain on-demand videos as well. So 5 plus 5, 10 courses of value close to 15,000 rupees, but you are going to get it for 1 year access rupees 2499, lifetime access rupees 4999. Not yet over. You are going to get access to the 11th course, how to assess non-fund based credit facility. So in this course you will learn about letter of credit, bank guarantee, its assessment as well. Then comes course number 12, how to do term loan appraisal and assessment, because it's a complex process with a lot many technicalities. So this course covers all in detail. And course number 13, basic elements of loan proposal. So how a typical loan proposal will be, what are the basic elements that are covered in this course. And we have course number 14, case study on credit analysis. Various case studies based on practical experience and discussion with various bankers and finance professionals are included in this course. And course number 15, this is about collateral securities, where you get knowledge about collateral securities. So overall it's 15 courses of value close to 22,485. It's 1,000 plus lectures. You can subscribe for 1 year access or lifetime access as you wish. These are all pre-recorded courses, so you can access them anytime as per your convenience. You can access them in mobile app or desktop, and for you the price is not 22,485, it is rather 2,499 for 1 year access or 4,999 for lifetime access. You can check the link in description, where without using any discount coupon code you can enroll at this discounted price, because it's a discount applied link. and not yet over, you are also eligible for some more bonus. The bonus is access to various ebooks and e-resources. You are going to get access to various financial ratios ebooks, financial management related ebooks. You will get access to financial analysis related ebooks, credit analysis ebooks. Not yet over, you will also get access to other resources like test series, templates, audiobooks, video books, career guidance material, and a bonus resource. Check the link in description and enroll now.